tonight we're starting part 2, and we are eager to hear from the panelists in this portion that are focused on the capital raising side and on the industry side, and looking at it from the point of view of the investor and of the emerging fund manager that is looking at their strategies for managing the fund. And we'll first start out with Mike Loughton. Mike Loughton joined Pulteney Street Capital Management as a member in February 2013 after having spent the last 12 years with Presidio Management, LLC. At Presidio, Mr. Loughton was responsible for sourcing, evaluating, and managing hedge fund investments within the Presidio funds. Since 2000, Mr. Loughton began his career with IBM Corporation in the software group. He holds a BS in finance and an MBA from the Huntsman School of Business at Utah State University, and was a recipient of the Hewlett-Packard John Young Assistantship. Mike's experience is on the investor allocation side, and he ran a fund until recently that was investing specifically in unidentified emerging investment funds, and he has extensive experience with understanding what a fund manager needs in order to be successful.
Great. So as John mentioned, for the past 18 years, I've been investing and allocating to hedge fund managers, and in that time, a partner of mine and I ran a direct strategy as well. So I know what it's like on the allocation side, and I know what it's like on the emerging manager side, trying to raise money for yourself. I'm glad to be here, and I'm an advisor to the Global Center for Investment Fund Studies, and so I'm really excited to participate with this center and learn over the next year to see what we can learn on any changes in fundraising and yeah. So let's start. So you wanna run money. The first thing you need to determine is why. Why do you want to run other people's money? Why do you want to do it in this specific strategy? And why do you want to do it in this structure? Running a hedge fund used to be the ultimate get-rich-quick scheme. It's not anymore. It's a business, and it's a tough business, and it's a competitive business. And so if you think you want to do that, you really need to be passionate, and you need to be prepared to do it, whether you're making the money you think you're going to make or not. It's got to be in your blood. It's just not like it used to be in the late 90s and early 2000s. Why are you going to be any better at this than your competitors? Why is the strategy repeatable? Investors quickly forget and frankly don't care about past performance. They want to know what are you going to do for them tomorrow, and how are you going to recreate what you've done in the past, and how are you going to convey that to them that you can repeat your performance. And then the final question, why should I trust you? Why should I trust putting my money with you? So find your niche. It's got to be defined. Figure out what your investment edge is in whatever the securities you're trading, whatever your process is, and then command it. Really, you've got to have command of your strategy. And when you're going out to start to raise money with these initial investors, you've got to be able to lay it out like a story. It's got to be compelling, it's got to be consistent, and it's got to be consistent across your firm and stay consistent. If it's not going to land. So now you know why. You know what, but how are you going to do it? You've got to have a business plan. It's running a business, and I can't tell you how many times that we've seen good managers who just run terrible businesses and aren't successful. And it starts with service providers. It is extremely important to find service providers and view them as partners, and more importantly, they need to view you as a partner. They need to take your success personally, and really when you're going out and searching for the law firms, the administrators, the auditors, you need to make sure that they care about you succeeding and understand what it's going to take for your firm to succeed. Collateral is important. You know, every potential investor is going to ask for all the collateral you have, the full set of fund docs, your pitch deck, and everything. But more importantly than that, you need to be able to connect with them through conversation. You need to be able to articulate why they should partner with you. Investors decide within the first 20 minutes whether they're interested and they're going to continue to pursue that, or whether they're just going to dismiss and move on. And then finally, agency theory. If your entire net worth isn't in the fund, whatever that amount may be, they're not going to be interested. So, for instance, a friend of mine named Brian, I met him back in 2007, and he had a $7 million fund. $5 million of it was his own money and was his entire net worth. He had done great prior to that, been very successful trading his own money, built it up, and launched this fund. By the mid-2000s, he had $35 million in his fund. No, but by mid-2011, he had $35 million in his fund. 18 of it was his. Contrast that to somebody. I was in New York this week talking to some managers, and I met a guy who's launching a fund, and he's had tremendous success in his past. This guy's worth over $100 million. He's launching with $30 million, and a couple $1 million of that is his own money. So he's worth well in excess of $100 million. He's got a $30 million fund. He's got a couple million of his own money. I feel much more comfortable putting my money with Brian, who's got his entire net worth in the fund, than with this other guy who's proven to be successful, but Brian's going to sleep, eat, and breathe that fund. Because if I lose, he loses everything. Risk. Let's talk a little bit about risk controls. That's what all the investors care about is risk. What's your risk management process? How are you not going to lose my money? I've never, I guess I've only been doing this for 18 years, but I have yet to come across a strategy that wins in unchecked perpetuity. It doesn't exist. Every good investor has drawdowns. John Templeton had drawdowns. Buffett has drawdowns. It happens. Sell-offs and down periods, they come about, but they're opportunities. And what you need to know is you need to understand your capital base. Can they be patient enough, long enough for you to take advantage of those opportunities, and will you be solvent to be able to do that? And yeah, finally, risk and volatility are different. Everybody in business school, you study volatility, and it's a number. It's not a number, okay? Risk is a permanent loss of capital. So once you once you start to define your risk management, define the volatility of the instruments you trade, couple that with the investor appetite you have and their time horizon, and then from there you can develop a risk framework, your risk budget, and come up with a risk management strategy. And finally, one thing that we always look for is just smooth returns. They tend to be pretty identifiable. Cautionary notes. We often get questioned about fees. Should I discount my fees? You know, my recommendation on that is stay within the standards of the strategy you're running. Oversized or undersized fees, throw up caution flags, and know what you're worth and demand it, and go out and earn it. Understand who all the competitors are. Understand who the other players in your strategy trading the instruments that you're trading are. Don't say nobody else does this, nobody else invests in this, nobody else does this the way I do it. If nobody else does it, there's probably a reason. And if nobody else is going to play in your sandbox, your securities or whatever you're trading can't appreciate. Know who the big players are, how you relate to them, how you can compete with them, and investors are looking for emerging managers. But it's a lot of work. You got to knock on a lot of doors. You got to be persistent, and again, you've got to be consistent. Consistent with your story, command your strategy, and be persistent, and it can happen. Typically, a manager's best years, if they're going to be successful, are their first 3 years. So that's why we try and go out and find those managers and feed them when they're lean, mean, and hungry. The trick is our job is to try to identify which ones are going to be successful, but we'd much rather fund them early, get those good returns early, because you tend to see a lot of degradation in returns the longer the track record goes. And finally, don't set up multiple funds and multiple strategies until your first one is scaled. If you build it, they won't come. And then I'll just leave you with Montier's laws of investing. I have this on my wall next to my phone. Every time I get a call, every time I'm done with a meeting, I look at this, I think about it, and I think if you can follow these and really think about them as an investor, it's really going to help you protect losing capital. But it is always invest on a margin of safety, or insist in a margin of safety. This time is never different. Be patient, be contrarian, wait for the fat pitch. Again, risk is the permanent loss of capital, not a number. Be leery of leverage. You know, leverage is a great tool, but it works both ways. And finally, never invest in something that you don't understand.
Great. All right. Thanks, Mike. And so Mike Loughton will be helping us to design the study together with professors that are focused on investment fund studies, and by having someone like Mr. Loughton that has years of experience knowing what he's looking for in a fund, it's a very valuable resource for emerging managers that are looking for education and designing a study that will be meaningful. And just to follow on with Mike's presentation, the number one issue that I see with emerging fund managers making mistakes with their capital raising is their overbreadth. And so just like you shouldn't run multiple funds until the first one is executed and successful, you shouldn't run multiple strategies that are outside of your core competency. Now, there are certainly times when you need to run technically more than one trading strategy to accomplish a single objective, but the desire that fund managers have to provide an offering document that is dripping with different opportunities that they may pursue is really misguided. And often we talk to our clients and ask them, if you only had to bet on one of these strategies, which is it that could get you there fastest, and which is your specific background most closely aligned with? Because that alignment of your own skills is what makes you as an emerging manager so interesting. It is, you have the ability to be scrappy, to identify and exploit an opportunity because you're small. So try to stay with that and not jump it. It looks like we have a question. Vanessa, would you mind running the mic over there? If you wouldn't mind, ask all your questions and follow-up questions in the mic so that we have the benefit of the webinar audience.
How does that highly focused approach line up with sort of the famous strategies that venture capitalists use, where, for instance, Y Combinator invests in dozens of companies with disparate strategies on a quarterly basis, pretty much, and they hope for, outsized gains from just a few of those, and they have no idea which ones those are going to be.
Yeah, that's a good question. So, but if you think about it, that's two different things. So Y Combinator, so it's venture capital, right? For venture capital, the strategy is venture capital. You are betting on these emerging companies to have success, and you know that it's going to be 1 in 20 is going to have tremendous success. So you've got to diversify. But if Y Combinator came and said, we're going to do, or venture capital fund A, whatever call it, we're going to do venture capital in this fund, but we're also going to do cryptocurrency or something else. That's all of a sudden now you've got two different strategies or multiple strategies within one fund. So you're right. You've got to diversify. So for instance, if it's a cryptocurrency fund, you want to make sure that the assets within that fund are diversified, right? That it's not just, hey, we're going to go buy XRP and it's going to go up.
Yeah, we're not saying not to diversify your holdings or even to hedge your holdings with a complementing strategy that is in line with your main strategy. What we're saying is to have enough discipline to do the job that you have initially set out to do. That you're not, as entrepreneurs, you're going to naturally identify one path, and along the way there are other shiny objects, right? There are other opportunities that could come into this, and so we'll start out with a manager that wants to do one strategy, and then they look at what they could someday do, and the feeling is, and it's misguided in my view, is that you need to capture all these opportunities within a single offering document, because then you're allowed to go outside of that. Well, in reality, as Mike pointed out, when you raise capital and you form a fund, you're forming a family of funds. You have a separate management company and a separate GP because you're forming the first fund in a family of funds. And you're not starting a fund so you can start a single fund. You're starting a fund so you can start an entire management company. This first fund is Fund 1, and it has GP1. Now, if you go and want to form another fund, you have this investment manager holding the track record, and you're able to form GP2 with Fund 2, and you're not crossing liability. And so if you do see a lot of opportunities that are outside the core strategy, keep them in mind for subsequent fund, knowing that Fund 1 is going to hold the track record to enable you to then go and create additional strategies. And if you come across advice that unless it has some other reason for it, to have a single management company and GP, just know that the reason you separate those is so that you can do these additional funds, and so that you're not forever consigned to this first strategy you put on the page. You get that fund, you do well, and most of our most successful funds, and I saw this in a large firm environment at Aiken Gump. I see it now. The successful funds generally have a family of funds doing different strategies. Certainly required in a closed-end private equity structure, but even the hedge funds, you're going to want to pursue different things, and as you get larger, you have the luxury of diversifying the strategies in addition to the holdings, because you have now commanded more respect from your investors. You've gained more financial strength to be able to have multiple managers, and that's when you want to be diverse.
Let me make a side note to that, though. But investors are paying you for your expertise, and you're not going to be an expert at everything. And so, if you're a mile wide and an inch deep, you're really not worth a fee. Okay? You're charging a management fee, and you're getting an incentive because you are really good at something. And so, focus on that.
Great. Appreciate it. All right. Next, we have Shane Fizdak. Shane is a successful cryptocurrency trader and algorithm engineer that has generated significant profit over the past 5 months. He will soon be launching a fund. Prior to this this new fund, Shane has built other successful trading and analysis algorithms. Along with trading, Shane is a portfolio manager of the tech arm of a multi-billion-dollar hedge fund. Shane has also been involved in the MIT Launch Entrepreneurship Summer Program, and we asked Shane to join us to talk specifically to the strategies, more so as an investor, and for the benefit of those that are looking to learn broadly about how the algorithmic trading model has become a very large part, not just of cryptocurrency, but of managed funds generally.
So like John said, I come here as an emerging fund manager, so I'll be a little bit more brief, since some of my reports might be a little bit better over Q&A. So over the past 5 months, I developed an algorithm that has gained about 1,400% profit just from almost exclusively volatility-based investing, and we've had a 90-day winning streak. Of course, like the old adage, past performance is certainly not indicative of any future performance. why we haven't completely started our fund yet. So I'm in the process of learning the space, learning the compliance, all the regulatory. The fund is 100% my money. So I wanted to, I'm a firm believer of having as much skin in the game as I can whenever I'm starting a new business, whenever I'm part of a fund. So it's been important for me to, one, focus on a very specific strategy, and two, make sure I prove the concept before I lose other people's money. I'd much rather lose my own. Up to this point, the entire strategy has been based around sentiment analysis. So a little bit about my background. I originally started as a sports gambling algorithm developer, where we focused on algorithms around small conferences versus large conferences in college sports, sentiment analysis around news, players, things like that. So I was able to apply a lot of those same models to what I'm doing now, as I was back then with some of that success. I then came into an oil and gas hedge fund where I managed the diversity of the technology arm, where I also developed other algorithms and learning models, and started 3 software as a service companies. Now all of which are in the 9-figure revenue range per year. Same concept. I kind of wanted to be as well-rounded as I could in terms of a business manager along with a money manager. And I was able to build a lot of these same algorithms in terms of running the business as I was in terms of making predictions. So going back to a little bit about the strategy itself, and then I'll hang up for better Q&A. What we've really been focused on is the news cycles around these coins. As many of you know, this is an inefficient market. Whenever news is mentioned at all, it has some sort of effect on the price. So we've been looking at things like the volume of news, which has been one of the most indicative variables here, but also who the news is in front of, when it's being mentioned, where it's being mentioned, and so on. And then we base it on kind of a ranking system of where we'll put the coins and whether they're worth investing in. Again, we've been focused on just building out this strategy prior to launching any fund, and so far it's been profitable.
Thank you. And I'll add to that in setting up a cryptocurrency fund, strategy and narrowness of strategy and focus is important, and it's also important to know what loose category you fall within, and within standard funds, standard equity based or managed futures or other forex, etc. We have some fairly neat categories that we try to put our funds in. What we're seeing with cryptocurrency is kind of a similar idea. You've got an arbitrage-focused strategy. You've got the index fund. The index fund is falling out of favor because more and more people have access to trading technology that makes it easier for them to get online and trade themselves, especially just given the small overall capitalization of cryptocurrency and really the concentration towards the top of the value of them. But you've got your index funds, the fundamental strategy, and the largest of all, which is the quantitative, algorithmically based, machine learning, AI derived strategy. And these are across the board with a news focused strategy or an intelligence focused strategy, funds are using technological innovation to very rapidly track momentum of news and some of the ebbs and flows of the news cycle, which right now, because there is so little in infrastructure, in terms of infrastructure, that is certainly something that that fund managers are exploiting and doing well, and the convergence of cryptocurrency as an investable asset class and bright, tech-savvy managers creates a lot of opportunities with, I dare not go into the actual terms, but building out APIs and various models of using available and custom software technology is an area that is green with opportunity, because there is so little competition in certain areas. So it's exciting to see these type of managers take advantage of opportunities. Finally, we have Gary Bernstein, and actually Gary, we added him very recently to the panel. My apologies there. And Gary was actually in Israel.
I was just in the London blockchain
in
expo.
London and from Israel, and so we wanted to give him an opportunity to come out here. His background and his specific focus is representative of a number of startup tech companies that are developed to support the new cryptocurrency craze, and there are certainly a lot of different startups with a lot of different ideas, and we were impressed to see where Gary has been, and we're fairly newly introduced to him, but fortunate to be able to have him give the perspective of a founder of a blockchain-related supportive company that is sort of the future of the type of infrastructure that will eventually firm up in this space.
Thank you. All right. Guys, it's really an honor to be here, and it's just so relevant to what we're building at CoTrader. CoTrader is basically a blockchain-powered, not blockchain-related, but blockchain-powered, on the blockchain investment fund platform. It's a marketplace for investors to find investment funds, right? And the performance is proven on the blockchain. So you can't report it wrong. It just, the guy knows what you've earned, and he knows what you charge. And you have to charge something that the market will bear. So it really represents a disruption, potential democratization and disruption in the hedge fund industry. Cryptocurrencies allow that. Smart contracts allow that. Smart contracts where trade can be done not on, anyone here does trading on Binance or anything like that? All right, does anyone in here go into ICOs, pre-ICOs? Okay. So on Binance, if you were to copy someone's trades, okay, there are some platforms out there, eToro, co-vesting, CoinDash, a lot. Copy trading is a very intuitive idea. It's that someone knows, I mean, we're all here because of this concept, is a hedge fund, investment fund, it's in a sense copy investing, copy trading. Whatever the guy does, you do, right? So because he spends 24 hours a day studying the market, and it's a very complicated market. This isn't your grandfather's market. This isn't Coca-Cola and Gillette razors You know, this is very complicated software products that are built on top of other software complicated products, and not all of them are scams. There are a lot of scams out there, and the SEC is trying to go after a lot of them. And by the way, it's kind of interesting. The SEC was initially, I think it was 1933, during the Great Depression. It was initially founded for a specific purpose to prevent fraud. But, you know, I ask, you know, are those purposes still valid? I'm curious if some people are going to take them, you know, maybe to the Supreme Court about some of these issues. Because what's the purpose of blocking people from investing in, you know, maybe securities and so on? So some of that might be shaken up. I don't know. Well, that's interesting to see. But also, you know, so with the SEC saying that a lot of these things are securities because people are getting in them to make money. As such, you know, performance is an important factor. So again, platforms built on the blockchain because of cryptocurrencies, because of the Ethereum blockchain, because of smart contracts, where trades can happen not on some central server like Binance, where you don't know what happened. You don't know what your fund manager really earned. You only know what he reported to you. Okay, but when you can do decentralized trading, when the trade happens peer-to-peer, the trade happens on the blockchain itself, on a decentralized exchange, these networks are coming up such as Bancor, Kyber, 0x. These are coins that are doing fairly well. 0x is worth $500 million. According to CoinMarketCap, it was much higher than that before too, but now it's growing again. This is a protocol for decentralized exchanges. Bancor is a very interesting one that's completely on-chain. That, for example, at CodeTrader, we use Bancor, Kyber, 0x, AirSwaps. We call ourselves a super decentralized exchanges as a DEX. DEX, important word. We're a super DEX infrastructure that ties together the liquidity of all the decentralized exchanges and maximizes their power because they're just growing. They say 2018 is the year of the DEX, of the decentralized exchanges. You see Binance going from leaving Japan, going to Malta, finding new, ways to, find legal, surroundings that work with them. So actually, one of the things that all of you guys are interested in is, well, how do I do this legally? Well, if you had a platform, let's say, other people are doing this too. I was just in a conference in Dubai, in a blockchain world forum, and there was an interesting under Yenching. There were some interesting projects that were looking for compliance, how to do compliance, and CodeTrader would be looking to partner with some of these guys so that you can do compliance in one standard way. You check the box. You're a U.S. citizen, live in the U.S., manage under 100 million or over 100 million. Here's what you need to do, and here's who you can accept, all automated. So this is part of some of the things that CodeTrader can help with because it can tie in automatically. It won't let you, the software won't let you, cheat basically, take any more money than you said you would, and your proof of performance and the compliance happens, through code. And additionally, there may not, now this is interesting because a lot of hedge funds won't survive this because why would people invest in ones that don't? It's the Airbnb, it's the Uber of hedge funds. Why would someone use a bad hedge fund? Like, you have the guy's performance, it's right there, you can see a list of them. So the market may not bear management fees in the future. It may only bear incentive success fees. It may be in high success fees, such as 20%. Some of these co-vesting are taking 18, 20% success fee. Now in CodeTrader, we let the market decide. But let's just say this is very attractive, on the other hand, for good fund managers. Let's just say you charge 10% success fee. Now, say you're a YouTuber, an influencer with hundreds of thousands of followers, and you tell your guys, hey, come on here. You've been listening to my signals. Let me try to prove it. Now, they could try to prove it after half a year, or people may join him. Let's say he's trading 100 times his own money. By the way, he can have skin in the game, and you could see exactly how much skin in the game he has. Every wallet, the fund manager, it's his wallet address, and you can see, okay, he has 10%, he has 1%, he has 100%, whatever. So on these platforms, so let's say a YouTuber brings 100 times his money and charges 10% success fee, incentive fee, right? So that's 10% of 100 people, 100x. So it's like whatever he would earn, he would now earn 10 times more. So let's say crypto was crazy last year. It did 50x. People, some people saw these incredible, in the stock market, talking a couple percent here. Bitcoin went up 5 million times from May 22nd, 2010 till tonight. $1 would be $5 million. But there have been many 1,000x returns in crypto. Ethereum, 1,000x in 2 years. Stratus, 1,000x in 1 year. Neo, 2,000x in 1 year. things are moving 10x in a couple weeks. It's a really obviously exciting time where you're having, lots of volatility, but also, a lot of projects are just going to die off and they disappear, and a lot of projects are going to grow into something. So it's exciting time to see what will happen exactly with that. Yeah, sure.
So you said that the performance is being recorded on the blockchain. Are you recording the actual trades, or are you recording some kind of zero-knowledge proof of the return?
Great question.
Because if you're recording the trades, then people can back out your strategy, right?
Exactly, right. So one of the great things about the CoTrader platform is that when I was basically coming up with it, is I wanted to make it decentralized, right? I wanted to make proof of performance and so on. But now that the trade is happening on the blockchain, anyone can see what you're doing, right? So why would you pay high success fees? Now, the market might bear some like 2, 3, 4, even maybe 5% success fee because of also celebrity involved and other factors. But at some point, it may become, it may be people will just create a copy tool and put it on a page and sell ads next to it. And but one thing is believability. Do you want to believe like what some page says, or do you want to use like like a proven audited brand? That's one thing. But additionally, CoTrader happens to have patent-pending technology for advanced cryptographics techniques, as he's mentioning, zero-knowledge, succinct, non-interactive proofs. What these allow you to do is they allow you to prove the ROI, okay, allow someone to copy your trades, yet not know what they're trading. It sounds like magic. How can you copy somebody, have proof of their ROI, but not know what they're trading? And that's the power of zero-knowledge proofs. You don't know. You don't give away any of the private info. Now, in this case, the calculation is the ROI calculation. Simple. What did he trade? Asset A for asset B at time T for price P. So you saw like he traded this, and now it's worth this, and that's the ROI, right? Now, the private inputs to those you don't expose. You don't expose what the trade was or the date was and so on, but the calculation is out there for anyone to verify and see. And then this method outputs a proof function, which then another method can verify. So it's kind of cryptographic magic. And right now it's a little expensive to do this on the blockchain, gas-wise. It's not exactly feasible, but things are progressing in that, and it will be possible to do. We're also partnering with other, as I said, Yenching. They have other privacy techniques, such as ring signatures, it's called. So this is like Monero coin, for example, is a private sort of version of, let's say, Bitcoin. It, some people may store lots of wealth in Monero, because it's like less trackable. So actually, they say Bitcoin, oh, it's not trackable and so on, and the government doesn't like it. I would think the government loves it. It's completely trackable, 100%. You could see everything. It's better than cash, right? You can see everything that's going on. But Monero, has privacy. Now there are some important issues about this, political issues. Like, I don't want full privacy. I'm not an anarchist. I don't want someone to, do something illegal, like very dangerous things, and have a smart contract where you have a smart contract that says, does who knows what, right? But so these are interesting issues that we'll have to grapple with as a society. I hope I answered a little bit. The question is that you'll be able to hide the trade because of zero-knowledge proofs that with our algorithms, and we'll have other algorithms involved with Yenching and so on. You can follow up if you.
One other question from that is you said that participants could join in the trades of somebody they liked through these zero-knowledge proofs. So presumably they're getting to see the trades that are being output at the moment. Couldn't people wind up backing out the strategy from the trades that they're seeing?
Not exactly, but first thing let me mention is it's not that we're trying to secure your life savings or something. If someone guesses that it's your wallet, that's not the end of the world, because is he going to put $1 billion on a guess, or is he just going to pay the 5% incentive fee? So they may guess that that's your wallet, but they won't know. So it's not like we're trying to. It's not, security here isn't mission critical. It's not like the rocket ship is going to either succeed or blow up or something like that. Is that we just have to give enough doubt to your knowledge of if that guy, if it's the fund manager's wallet or it's maybe some other guy. Now, how it specifically it works, without getting too much into the IP, is that there's a trade that happens that takes you into an anonymous, from your smart fund into an anonymous fund. Once you're in the anonymous fund, no one knows that the money. So it's based on technology similar to Zcash. Zcash is like Bitcoin. It's a Bitcoin fork that basically adds privacy, cryptographic privacy, meaning like mathematically proven privacy. The way it works basically is that it only stores, it doesn't store, you don't know who sent what and how much. So you see that the whole tree is correct, everything is correct, the whole Merkle's tree structure is correct, but you don't see who sent what. You just see that's correct, right? So we use the same concept. We send money from your smart fund to anonymous fund, no one knows where it's sent to. Then you do the trades, no one knows what's going on there. Then we report back the ROI. No one knows where the report came from. We just know that it was done correctly. So that's kind of how a little bit of the magic.
No, I appreciate that, and I think this on a legal basis and what would need to happen there. I mean, I think that's to unpack and to see, and our firm wouldn't have any thoughts on that yet, but this is an example of the type of technology that could be used to further this concept of democratizing the capital raising process, as the GCIFS is looking to do. This is, for me, the first I had the opportunity to hear of this, and it's very fascinating, and
Definitely.
Really appreciate you joining us and flying from London to.
It was my
come.
pleasure being at this amazing event. So
Okay.
thank you very much.
Appreciate it.
Yeah.
And then we have just a couple minutes for some Q&A.
Thank you.
So any on the capital raising side, on the strategy side, any questions? Wait for the mic there.
Great, thanks. So my question has to do with Gary and John. So I've been on sites like eToro, and I think they're fascinating. Last time I checked, they weren't taking U.S. investors. So how does your site then work with the legal structure? Is it going to be accredited only? What are some of those hurdles?
Right, so one of the reasons they don't take US is because they do CFDs, contract for difference. They don't actually hold your assets exactly. Assets aren't exactly traded. It's very different from what we do. Some similar competitors like co-vesting or CoinDash or some of these other ones, they actually do take your assets. Now, what's dangerous there, unlike if you just do one quick trade on Binance, it's not so dangerous. You send the $1 million in Ethereum, you take the $1 million back in Bitcoin, it's back in your wallet, okay, you survived, right? But are you going to keep $1 million, or like your life savings for copy trading on a centralized exchange where it's like a bag of diamonds, right? You sent it, it could be gone, someone could hack it and it's gone, right? So that's why a decentralized co-trader is much safer that way. Now, to answer the question with eToro, it may not be exactly that dangerous in that sense. You send them some assets, you have to hope that you can get it back from them. But also because of the CFD issue, I think that's why the US has a problem with it, for one thing. But additionally, like regulation-wise, this is one of the very fascinating things that I'd love to understand more from this panel, and I'd love to speak to some of the lawyers that were here, because we want to solve this sort of one time for everybody, and then have, this is my situation, here's what you're allowed to do, here's what you're not allowed to do, and a platform to help you with that. And specifically, I think that US citizens will be allowed to use the platform in some way, but it needs to be fleshed out more.
Other questions?
Hello. Yeah, my name is Aman. I'm managing a fund and also about to launch an exchange. Since we talk about decentralized exchanges and a lot of countries are banning cryptos, I'm coming from India, so it's very difficult to operate an exchange. Where do you see the future of decentralized exchanges? Because a lot of people want to trade on decentralized exchanges, but have the trust issues like, where is the face behind it,
Okay. Yeah.
and they could be tracking they could be tracking my funds. They could gone up from that as well. So where do you see the future of these centralized exchanges? And a person like me who is about to launch an exchange, should we revamp our strategies and move it to decentralized rather than a centralized?
I think decentralized exchange have a potentially huge upside. They're growing fast now, and for good reason. Without taking like too many political sides here, I mean, in some sense, governments are, working against, I feel, what consumers or investors or people are trying to do. In some cases, it's good. It's against fraud. In other cases, it can come into question. And I think that also you can't hold back technology and progress forever. Technology has always had a democratizing effect. The printing press, the internet, we went from despotism to monarchy and so on with a code of laws, with writing, okay, like code of, rule of law. And as technology progresses, especially the sharing of information. Now, what is cryptocurrency? It's freedom of speech. I mean, you're in a sense, you're sending actually a text message. It's actually just an encrypted text message, right? And yet, this is somehow a problem, right? So I think that there's going to be a lot of challenges. Obviously, governments have people with guns, and people are going to fall in line. But on the other hand, there could be some, challenging of certain things in Supreme Courts and so on. And I think that in the end of the day, when your sort of adversary has a tool, has a tool, then you sort of take a step back a little bit, right? And these decentralized exchanges, you're going to have to shut down the internet in order to use them, more or less. Okay, so I don't think they're going away. I think they're only going to get stronger. And of course, we want to comply with the governments and not against them. But I think that there's going to be some shaking up and stuff in order to, hey, loosen up a little bit. People want to use these things. And basically, I think technologically speaking, it'll be hard to stop. It's the bottom line.
So I'm actually going to work on an SEC campaign that says, loosen up, people want to use these things, as my main thrust of the whole cryptocurrency.
Yeah.
Other questions? Oh, looks like we have a few.
Hi, my name's Benjamin. Just had a question for Shane. I think trading on sentiment's a huge thing in this crypto market at the minute, given there are a lot of retail investors that do move the market on news that comes out and I guess current sentiment. But for you, if you're trading and need to have access to funds really quickly, presumably it's all on exchanges and hot wallets. How do you manage security with that?
So we only deploy a certain amount of capital at each time. Most of our trades are in and out in the same day. So all of the rest of the capital is in cold storage, is how we would handle most of our security.
And then just on that, how would you, presumably you have to react pretty quickly to news and events. If it is in cold storage, I know with Bitcoin it can take up to an hour to get it onto some exchanges, depending on how many confirmations they need. So are you saying that basically you'd always have 10% liquid on exchanges or
Right.
something like that?
Right, exactly.
Yeah.
Yeah.
Cool. Thank you.
Yeah.
I just had a question about kind of like benchmarking, sort of like in the traditional, I imagine, fund management space. If you're going to go try to raise capital, you have a benchmark against which you can say, oh, I'm going to outperform this. Is there something like that emerging in this space? Like, is it Bitcoin? It's easy to say, oh, I went 50x last year, but so did everybody else. So do you have a sense of whether that's going to emerge and what it might be?
So you've already started to see some indexes pop up. I think on HFR has a crypto index. How accurate it is, I don't know. But historically, with hedge fund indexes, they're not accurate because of reporting, right? Hedge fund managers who start to do terrible stock reporting, and you're going to see the same thing. So I don't look at whatever this HFR crypto index, but you're going to see them. It's going to be up to investors to to determine how accurate they are and what they want to benchmark you against. This is all brand new. It's going to be interesting to see how this industry unfolds and how the investors, compare this to investing in traditional securities.
Follow-up is, are the sort of investors that are investing money with managers, is there not that kind of pressure or pushback maybe doesn't exist yet? Are people just excited to have a manager that can get involved in the space and have the expertise to do it?
Yeah, I guess, I don't know the answer. I think the investors who are investing now with third-party managers, it's really a toe in the water. They're not comparing them to any of their other investment managers. They're just saying, what is this, and is it real? So I'm going to give you a little bit. They're gambling, and they know they're gambling. It's going to take another year, a couple years, and this is going to be an interesting year with what's happened so far. So we're going to see how these strategies in down markets react. And as more of you build out these strategies, it's going to make his strategy a lot harder to keep up, right?
Great. Other questions?
So this is for Shane. What kind of models are you using to measure the sentiment? I'm not asking about your trading models. I'm more on the machine learning, natural language processing side of things.
Say that one more time. Sorry.
What kind of natural language processing models are you using for the sentiment analysis?
So right now, up to this point, we're actually using mostly aggregation in terms of gathering news, and then just going through like the ranking process of making bets on who's mentioning, where it's being mentioned, time, and so on. So it's actually a pretty simple variable model.
It's based at this point. Okay.
Yeah.
Thanks.
Okay. Well, we better wrap up. Oh, do we have one more? Okay, let's grab it.
Hey, so my question is that when you talk about decentralized exchange, so basically, usually when you're saying decentralized exchange, it means like then is it purely decentralized, or like how does it happen? Let's say U.S. Might require like KYC, AML, for instance, some big transactions. So if it is a decentralized, do you still comply with that? In that term, is it still decentralized to one instinct, or is it at some point like still working with regulations?
Very interesting question. So the answer is, look, for example, we're going to do a token sale like an ICO. Maybe it'll close in a private round, like so many ICOs now. By the way, only the last 10% is done publicly, and some just cancel it because of legal problems. And it's just easier to raise privately from angels. And the cryptocurrency just sort of popularized angels coming together in big Telegram groups and make a pool and sales done, right, in an hour. But to answer the question, once, let's just say, someone creates a decentralized exchange. He puts his tokens out. He puts his smart contracts out. He's already made his money or whatever. He's now no longer, he may be responsible as some kind of enabler or something, but in some cases it's like open source software. He just created a tool for some people to talk. It's like a BitTorrent, or even with, it's just like a tool for some people to use, and he probably will just not really be held responsible for, it's just even less than BitTorrent. It's just a tool for people to exchange something, right? Something. And then people can use it however they want to use it. If someone wants to comply, then they should. I mean, they should. But there's not going to be anything stopping it because there's no website. There's not a website. Like, you can go access it through a website, but you can access the Ethereum wallet through anywhere, right? There's no shutting it down unless you shut down all the nodes, which maybe they'll do. Maybe the government will start kicking down doors and doing that. But I'm not sure they're going to do that. And if they're going to do that, probably it's going to move to another country that's going to be, you can't stop progress forever. And it's really interesting what will happen. But technologically, you can't really stop decentralized exchanges because they're so decentralized.
Thank you. And sorry, we're going to need to wrap up. Just we can continue this conversation afterwards. And this very interesting. Appreciate your additions. Most of our discussions that we've had so far have been very much focused on the practical aspects of raising capital, of safely navigating the various regulatory requirements, and anticipating the varying regulators and self-regulatory organizations that may come. And so it's refreshing to have a theoretical view down the line as to what things might be. Again, on the legal side, something in regarding in anything relating to the outside of the standard fund structure is not something that we would be able to advise on. Finally, if you are interested in learning more about the Global Center for Investment Fund Studies, reach out to myself, Bushra, or go to our website, GCIFS.org, and learn more. We'll be going to London next month. We'll be having a specific presentation on the custody issue, which is one of the biggest regulatory hurdles to growing investment funds to a considerable size. But thank you all.